2050 may seem like a long ways away, but companies that can compound their revenue and earnings power over the course of decades, 25 years, are going to be phenomenal stocks to own for investors. And the companies that have been able to do that over the past 25 years are some of the best performers on the market. Companies like Apple, Amazon, Netflix, these are household names, but they were 20, 25 years ago too. And so they have just been able to grow their valuations because of that sales growth and also multiple and profitability expansion. So what are the companies that are going to be able to do that through 2050? Well, I have 5 for you here today. If you want to skip forward to any of these, I will put them in the show notes. Some of these stocks are even in the asymmetric portfolio. That's a portfolio that I'm building from scratch. That portfolio has absolutely crushed the market since it began. So love to have you as part of that community. I also want to thank this video sponsor, Fiscal AI. You're going to see Fiscal AI throughout this video. But the great thing is it is a one-stop shop to do all your research. You can find all the company's financials, SEC filings, but the great thing is key performance indicators. That's information that they're pulling out of their earnings releases and SEC filings. Can make phenomenal charts. So it makes it really easy to see exactly what's going on with the company. But I'll show some of that throughout this video. If you want to try that out, go to fiscal.ai/ASYM. You can get 2 weeks for free and then get 15% off if you want to become a paying subscriber like I am. So let's dig into the 5 stocks that I like right now. First one, let's just keep it simple. It is Alphabet. Alphabet is one of the best companies in the world today. There's a lot of thought that there could be disruption from things like artificial intelligence. I simply don't think that's going to be the case. And I think AI is actually a tailwind for Alphabet long term. When you think about the models that they're building, the fact that Anthropic is building on Google Cloud, they have chips, they have distribution. They are the best vertically integrated company. And the stock isn't all that expensive, 26 times earnings. Now, I was buying shares back when we were looking at teens earnings. Pretty nice run up, about 57% just since April. So not quite the cheap stock that it was just a few months ago. But if you think about where Google and Alphabet are going to be 25 years from now, this is going to be a very different company. Think about what Waymo is going to be 25 years from now. That right now, a company that I don't think investors are really valuing very highly. Even Google Cloud has a long growth runway. Now, I've done deeper dives on Alphabet in the past, if you want to go back to some of those videos. But this is the one that I want to focus in on here is Google Cloud, because I think this is underestimated just how quickly this business is growing at 35% compound annual growth rate since 2020. And look at the improvement in operating margins. Now $9 billion in operating income. This is where the $85 or so billion that they're investing in CapEx in 2025. Rumors are that's going to be well over $100 billion in 2026. What Alphabet is doing is bludgeoning the competition with their balance sheet and with their cash flow. They're the only company that has enough cash flow to continually invest that kind of money year after year without having to take out debt. Oracle can't do that. Meta can't even do that. So I think Alphabet is in a much better position than a lot of investors think. Even consider the fact that they own YouTube, where you're watching this today. Incredibly valuable. More people are watching more hours on YouTube on TVs, not just mobile devices, but TVs, than Netflix. So a phenomenal growth story long-term for Alphabet. I think you can just set it and forget it. Paying 25 times earnings is not all that expensive when you consider where this company is going to be in 2050. I think this will be just a nice compounding company long-term, even if eventually it is broken up into smaller pieces. The second company is Uber. Uber, another market leader in their space. They're the leader in ride sharing. I own both shares of both Uber and Lyft. Lyft is a much cheaper stock, much more asymmetric potential, but also riskier. But if you're looking at what companies are going to be around in 2050 and be in a really powerful position, I think Uber is that company. Price to earnings multiple, let's look at it on a forward basis, is 29 right now. So pretty high multiple, but this is a company growing 5 years, 32% compound annual growth rate. And what I think really differentiates Uber from the competition is the fact that it has a more diverse business model. So right here you have mobility, that's basically moving people around in blue. That has been a solid growth business even just over the past few years. And then you also have delivery, not quite the same growth business, so maybe losing a little bit of market share to companies like DoorDash, but they're now moving into areas like delivering goods. I think in the future, you're going to see Uber be the kind of company where you can order everything from a ride to food to electronics. They've got a partnership now with Best Buy. I think that's going to be a phenomenal way for them to aggregate demand, so pull demand together. And they also do have a sizable freight business, something that a lot of us don't really consider. What they're going to do in the future is they're going to move more into autonomy. And the idea there is to lower their costs. So now instead of paying $2 to $3 per mile for a ride, with an autonomous vehicle, you can maybe pay $1 or even less than that. Now it starts to make sense to maybe not have a second vehicle or a third vehicle in the suburbs. Eventually, people stop learning how to drive. I've already seen that with the younger generation. That's going to expand that addressable market, the amount of miles that are going to be driven on a platform like Uber. So I think that is going to be a phenomenal tailwind. The other thing they're working very hard on is to try to commoditize their supply. You want to be able to be basically the choke point in the market. We call this aggregation. So if people are choosing to go to Uber to look for a ride, to purchase something, that's going to put them in a powerful position, because then their suppliers, which may be Waymo, it may be May Mobility, it may be ultimately Tesla. Those companies don't have that direct relationship with consumers. They have to go through Uber. That puts Uber in a very powerful position. And with the dozen or so companies that they're working with in autonomous vehicles all around the world, I think that puts them in the pole position. As much as transportation is changing, and we're going to have things like robots that are going to play a big role in this, I think Uber is still going to be the point that consumers continue to go back to access this technology over and over again. I just don't see them being upended as the go-to point for getting all these things delivered to you. Number 3 on the list is a stock that actually hasn't done very well recently. That is Netflix. Netflix is second in time viewed on streaming services behind YouTube, but it's still in a very powerful position, and I don't think Netflix is going anywhere. So if you look at a long time horizon till 2050, Netflix is a company that I think will be around. I'm looking at potentially adding Netflix opportunistically if the stock does drop, and it does do that periodically. We saw back in 2022, the stock dropped to about $200 per share. Now it's over $1,100 per share, but that's put a pretty high multiple on shares. 51 times trailing earnings, 41 times forward earnings. And I think the market right now is a little worried about how much is this growth rate going to change? Is it going to be a 20% growth rate? Is it going to be a 10% growth rate? That would really determine where you're going to look at from a valuation perspective, but it is a compounder long-term. This net income number is also improving year after year as they're able to squeeze more and more margin, and they get more leverage on the content that they're not only paying for or building themselves, but also licensing from other companies. So long-term, Netflix is in a very valuable position. Again, it's the place that consumers choose to go to for entertainment. I think that puts Netflix in a phenomenal position over the next 25 years. In a very different market, but also the choice that consumers are making, is Robinhood. Robinhood has been absolutely the most successful stock in the asymmetric portfolio, up over 600%, but there's still a long growth runway. What I'm showing here is revenue from different segments in the business. So in green, you have cryptocurrencies, obviously something that was doing well in 2021, but now it's an even bigger business today. Options used to be about half of Robinhood's business. Now it's not the main driver of the business anymore. The main driver is actually net interest revenue. So this has become much more of a fee-based business that's more like a traditional brokerage. The great thing about Robinhood, though, is they're a digital-first business. So they're able to have different economics than companies that are building branches all over the world. They're also able to expand, leverage the thing that they're building in one country, expand it all over the world. I think there's going to be phenomenal growth as they expand into more geographic areas, as they offer more products, as they bring new things to market that have only been available to really high-end earners. Things like prediction markets. These aren't things that wealthy individuals haven't been able to do for a very long time. These are futures contracts. It's just now that those things are being brought to regular people, to regular traders. That's going to be a tailwind behind Robinhood long-term. So I love their position. It's not the cheapest stock, but again, take that runway out to 2050. This is a phenomenal company to own long-term. And finally, Coinbase. Coinbase has not gotten the attention that it once got a couple of years ago, but the operations of the business have been phenomenal on a trailing basis. Price to earnings is 36. Forward basis, that's 60. We'll see where things end up. It's a little bit difficult to predict exactly what Coinbase's business is going to look like, but I think when you look at their financials, this is now a money-making machine, very profitable business, and they're moving into areas that should be sustainable and growing long-term. Here we have their revenue streams going back to 2019, and what you'll notice here is that this was a transaction-based business in 2021 when the company came public. Now there's a lot more going on at Coinbase than just transactions. That's still a huge piece of the business, but over $1 billion in revenue coming from the USDC stablecoin. There are also a lot of revenue coming from blockchain rewards, from the base blockchain. They're building out tools there so you can do things like invest in stocks and private companies. This is the infrastructure layer for the future of the internet. And I think that's where the ultimate opportunity is. This is like investing in AWS in the 2000s. Coinbase is building that level of infrastructure. I think what you need to keep an eye on is stablecoin usage. how well the base blockchain is doing. Are people using that? Coinbase wallet, they have wallets as a service. And who's using their other services tools? This other subscriptions and services, this is in red, but look how quickly this has grown over the past few years. We go back to 2021, this was $132 million in revenue, now $410.5 million in revenue. A lot of things aggregated in here, but this random group of services that Coinbase is bringing to the market in Web3, as it's called, in cryptocurrencies, that's where there's ultimately going to be explosive growth. And I think we're starting to see that break point. I think we're starting to see stable coins be a much more efficient payment method than credit cards are. The fees that you see on something like Stripe for taking stablecoins are half of what it is for credit cards. So I think we're starting to see that tipping point. Coinbase is going to be one of the beneficiaries. But if you look out to 2050, what exactly does the business look like? We don't exactly know. And that uncertainty is actually an opportunity for investors today, because what you're doing is you're betting that Brian Armstrong and team can figure out what the future is going to look like. A little bit like betting on Jeff Bezos 25 years ago. That would have been a phenomenal bet. So there you go. There are the 5 stocks that I think are worth holding through 2025. Some of them are in the asymmetric portfolio. So like I said, check that out. You can see how I'm beating the market, buying stocks just once a month, just steady as it goes, building that portfolio over time. But if you want to go back, check out any of those stocks, Alphabet, Uber, Netflix, Robinhood, and Coinbase. Let me know which one is your favorite out of that list. Don't forget to subscribe here on YouTube. Thanks for watching, everybody. We'll see you here next time.